Hey there, everybody. I hope you're doing fantastic. Dylan Estes here, branch manager. Excited to break down for you your rate buy down guide. Buy downs are a way in this higher interest rate market, right, to ultimately achieve a little bit lower interest rate. So the aim here is to take you from my boy Trevor, who just looks perplexed and in over his head, and what all this means to, man, you're an educated borrower, you feel good, you're ready to proceed and go get that house that you want. So no need to stress. I'm here to break everything down for you so that I can help you make a well-educated decision on what's best for you and your family. So first thing to know is buy down is essentially a way for you, the borrower, to obtain a lower interest rate by paying discount points at closing. Discount points are also called mortgage points or prepaid interest. They are a one-time fee paid upfront to achieve a lower interest rate. In the case of discount points, the interest rate is lower for the term. So it's going to be on a permanent discount. Okay. So speaking of which, there's two types of buy downs. You have temporary and you have permanent. Temporary is a buy down when a party in a mortgage transaction pays a lump sum to reduce their interest rate for the loan's first 1 to 3 years. The buy down is covered by the sellers and results in you, the buyer, having a temporary lower payment on a fixed rate term. So, for example, like a 2-1 buy down. Let's say you have a 6% note rate. The first year you would have a 4% because it's a 2, that's that 2. And then the second year you would have a 5% because that's the 1. And it wouldn't be until year 3 that you actually took the note rate of 6%. Okay? So first year, 2% lower. Second year, 1% lower. You don't get the full term note rate until year 3. That's probably still a little bit confusing. It won't be in a minute, I promise. And then your permanent, now we're buying down that interest rate down for the entire term of the loan. So if you're on a 30-year fixed, we do a permanent buy down. The interest rate will be the discounted rate for the entire course of the loan. So essentially, think prepaid interest to save money in the long run. So for example, a par rate or a rate that wouldn't cost anything to your closing cost, let's just say for conversation's sake, it's 6.5%. All right. Well, on a $200,000 mortgage, if you wanted to buy down 2 discount points, so $4,000, you could essentially take that 6.5% to say, I don't know, 5.5%, give or take, and save that money on a monthly basis. And again, just shooting from the hip here, let's say it saved you $250 a month. Well, that permanent buy down would make sense if it cost $4,000. Just doing some quick math, $4,000, $250. It makes sense after 16 months. So in less than a year and a half, you've justified that buy down in that scenario. It's not usually the rule of thumb is 36. As long as we can recoup in 36 months, the average mortgage stays alive for on a 30-year fix. They stay alive. Typically, you refinance or you're out of that mortgage for one reason or another within the first 3 to 5 years. So I try to stick around that 36-month mark. Again, that's a lot of numbers. That's what you got me for. What's important to know is whichever way we go, if any, your specific situation will be noted. So a few things to note: temporary buy down must come from the sellers. It comes through what are called seller concessions, and it is limited based on the loan type and then how much down payment you're bringing. You are limited to how many points you can buy down on a permanent. You can't go more than about 2%, 2.5% of the loan amount is the general rule of thumb. Form estimates again that the average mortgage has a life of about 3 to 5 years. Nobody has a crystal ball. Okay, I'm not sitting here making any guarantees or projections, but the analysis of people that are a lot smarter than me and that I subscribe to help me educate you. Basically, the projection is over the next 18 to 24 months, we will see rates come down. It's probably going to be closer to, now I am making a projection, but I do expect about next year rates will be, I think they'll be a little bit to the consumer's side. That being said, we do semi-annual reviews to make sure you're always in the best position. So you get in a rate, whether we go temporary or permanent. We'll talk more about the difference in the future. If rates do come down, we will definitely make sure you're aware of it for that refinance opportunity. Uh, Generally, these both are going to be applied to your fixed rate mortgages. You cannot lose your seller concessions on a temporary. So in the event that the rates come down, let's say we did a 2-1 buy down. First year you're at, and then from the example earlier, you're at a 4%. And then the permanent rate, like the market comes down where I do that semi-annual review, man, I could get you from a 6.5 to a 5.5% on the rest of that 30-year term. I'd be able to reach out to you, get that refinance completed, and then any portion of the seller concessions that hadn't been applied to the monthly payment actually come off the principal amount. So you cannot lose that money is the short of it. That's what makes that temporary buy down a very powerful tool. And then it is important to note that that refinance opportunity would be dependent on you actually being credit worthy and able to qualify for that refinance. And you can do both a permanent and a temporary buy down, which we've done quite a few here in the last several months. All right. Why would this matter to the seller? Like, why would the seller want to give you money to buy down your interest rate? Well, it's because the market is an ever moving, breathing thing. It's been a significant shift to the buyer's favor in the last 6 to 12 months. Buy downs are a way that you can offer a win-win solution for you, and then also the seller gets their home off of the market instead of just sitting there and waiting for offers to come in. Usually when we do this strategy, your realtor and I will talk about it, see what our best course of action is depending on your loan type. But let's just say it's a $300,000 home. Instead of them, and it's been sitting on the market for 30 days, well, rather than having to go and do a price reduction down to say 280, we come in and do a at ask price, but get for our $15,000 worth of seller concessions to take care of your closing costs, your temporary buy down, your permanent buy down. They're up $5,000 from what they were going to do on a price reduction anyway. So it helps. The permanent buy down does help you qualify. Temporary buy down does not. And then the more people for the we have a better chance of winning these things whenever we're in a property instead of competing against 3, 4, 5, 6 people. It's just us, maybe us and one other offer. Those are the situations we can typically get seller concessions. So type of temporary buy downs. There's the 1.0. Only lower for the first year by 1%. So for example, if the note rate is at 6.5, the first year it would be 5.5, and then years 2 through 30, it would be your standard 6.5% for that the other 29 years. Okay. 1.1, same concept. It's 1% lower for the first 2 years. So 6.5 would be 5.5 in year 1, 5.5 in year 2, and then years 28 through 30, it'd be 6.5. 2-1 buy down. Is 2% lower first year, 1% lower second year, third year full note rate for years 20, what would be 27 through the end of the loan, 28 through the end of the loan, excuse me. Example, 6.5% first year, 4.5, second year, 5.5, 3 through 30 is 6.5%. And then you have your 3-2-1 buy down. This is specifically for FHA. Note rate is reduced 3% first year, 2% year 2, 1% year 3, and then in years 4 through 30, it goes to that full note rate. It's important to note here. This one I have not done this. I know brokers that have, but it takes a lot of seller concessions, and honestly, I would rather use that money for a permanent buy down and a 2-1 over a 3-2-1. But again, everybody's situation is different. We will strategize for you on what's best for you and the specific property that you're going into offer on. So here's an example to actually put some numbers behind it. List price, $300,000 property. You're putting your 20% down. Interest rate at par. And again, just note these rates. This is an example. Rates are demo version, only not to be used as a quote. Must qualify for mortgages for primary and secondary homes only. This example was put together months ago. These are not accurate rates for today necessarily. Whew. Okay. So let's say that note rate at par, not adding anything to closing costs, 6.933, APR 7.125, R4, 30-year loan payment 1608. They could do a 10K price reduction. Now they drop down to 290. Your loan amount is going to be 232 off of your after 20% down. Everything else stays the same. Your monthly payment is only roughly about $50 lower. So 10K price drop, $53 a month lower, and your 2-year overall savings of uh, you take that number times 24, you save $1,200, call it roughly $1,300 off of this. Instead, we go in, we catch them before they do the price reduction, or even after, really, and we say, hey, we like the house, we're going to offer you at full ask. We want $5,700 used for a 2-1 buy down. Your loan amount now, you're still putting your 20% down, 240. Instead of having a 6.933, you have a 4.933 year one, 5.933 year two. So your first year payment, instead of principal and interest being 1608, now it's 1296. In year two, instead of 1608, it's 1449. It takes the $5,700 in seller concessions, because if you add year one's $312 monthly savings, so 312 plus times 12, and then year two you're saving $159 a month. So 159 times 12, add those together, we get 5652. That's what I have to get from the sellers. But guess what? They come up, what is that, $3,300 that they still pocket more. So the sellers win as well. This is a win-win scenario. Both the sellers and the buyers come up. You're saving big on your monthly payments, and if rates never come down again, you're not going to get today's market rate until year 3. All right, so pros and cons on temporary buy down. Pros: lower rate than permanent buy down. I can't get you for anything on a permanent buy down right now. It is obtainable on a temporary buy down. Unused funds are returned to the buyer if you either refinance or sell, or whatever the case is. There is no lost monies. Seller funds the temporary buy down, so it literally doesn't cost you anything. Win, win, win. That third win is the lender, but let's be honest, the lender's never going to lose. So the lender wins, the lender wins, you win, and the seller wins in a shifting market, and avoids a price drop for the seller to keep them, and it keeps you from overbidding. Cons: does not increase your buying power. You are qualified off of that note rate, the full note rate. Offer temporary relief in mortgage payment, but it is just that, it's temporary. Buyer would need to refi if the market drops, so you do still have to refinance into that lower rate, and you do have to qualify should the market drop. So that's why it's important to make all your payments on time and stay good on your credit cards. Now, on our permanent rate buy down, assuming a fixed term, permanent rate buy down is where the mortgage has a lower interest rate on the entire term of the loan. So one-time upfront charge. Borrower gets a 30-year mortgage payment lower after making that upfront payment. So again, this is just strictly quotes. But let's say you're doing a conventional purchase, 3% down. Your par rate, or rate that doesn't cost anything to your closing cost, is say 6.472. So you could pay $5,000 and get a rate down to 5.75 and save $112 a month. It would take about 3 years and 9 months to justify that rate buy down, but it would save $35,000 plus over if the loan was never refinanced and paid all the way through. That's how much you would save for spending about $5,000. Okay, so permanent rates. Pros: rate is fixed for the life of the loan. Buyer can qualify on the lower rate, so it does increase your buying power. Can net big savings over the life of the loan. Low risk. Cons: there is a break-even point. You do not get the money back if you refinance sooner, and if rates got lower than a permanent buy down in the future, you would still have to refinance to capture those lower rates. Does it work on all types of loans? Restrictions can apply on commercial, but basically on our VA, FHA, ARM, jumbo, and conventional, we do have lenders that do these programs. So I hope that this made sense and I made you as happy as my boy Dalton there, I look forward to custom tailoring what's going to be your best option. And ultimately, I aim to make it as affordable and have well-educated borrowers. So if you have any questions or anything I need to specify to you and your needs, please don't hesitate to reach out. Thank you, thank you, thank you for taking time to review this with me. Have a great one. Go win it.